We feel the pain of loss twice as much as, in this case, making money feels good.
Charlie Munger said this: if you can't stomach 50% declines in your investment, you will get mediocre returns you deserve.
We are living through one of the biggest bull markets in the history of the stock market. Yeah. Right now is the least confident, optimistic in the markets, basically in the US economy, that investors are ever. Welcome to Beyond the First Million. I'm your host, Gideon Drucker, alongside my taller colleague, Jordan Haynes. And we have 39 minutes to get him to the airport. So we're going to do this one tight, live. I'm kidding. We have like 2.5 hours. We're making good time. We do have to get Jordan to the airport, though.
Great. We're doing great.
And you strike me as a pretty relaxed traveler.
Oh, I'm chill.
Do you get there today aside 3 hours in advance, and are you rushing into the plane at the end? It tells a lot about a person.
When I'm flying out of where I live, which is Boise, which like no one lives there, so I can get there like literally 10 minutes before I leave, I'm fine.
They're like, Jordan, we're waiting, come on.
I'm last on the plane. I'm the last on, I don't care what, I just don't want to be on that plane forever. Not because I hate the plane, it's just like, I'm really tall, I'm like an accordion in there, so I'd like to stretch out.
We were talking about how couples plan, and it just made me think, like the personality type getting onto an airplane. My sister, like my dad, will get to an airplane 3.5 hours ahead of time to be prepared. Her husband, who is one of my best friends from college, whole separate podcast, we can get into that. I have literally, because of him, sprinted onto 3 separate flights, rushing to get into the thing because he kept us late and they're married. And I think like their breaking point is pretty much every time they go away, and now they have 3 kids. So hopefully the entire family takes after her. But yeah, he sprints onto planes on a regular occurrence and doesn't understand why would you want to get there early? That doesn't make any sense. No, almost missing your plane doesn't make sense.
Yeah, but the real question, here's, I think I asked everyone here around us, are you a 10 minutes early person or a fashionably late person, or like a I'm right on time? What are you?
10 minutes early is on time. If you're on time, you're late. Okay. And if you're further than that, don't even bother showing up. I'm channeling my dad with that, but that is actually how I also, I was in the Army. I was in the military. That is genuinely like, hurry up and wait is really the thing. You get like, hey, we have to be somewhere at 4 a.m. Awesome. We get there at 4 a.m. and literally nothing happens until 8 a.m. There was no reason. My military, not meant for logic. It's meant for discipline. With that, I'm trying to think of a clever segue. I don't have one, so we're just going to get rolling. This episode is going to be a little bit on the investing, the market side of things. I don't think we've literally ever done this before, but I would recommend going back and checking out the last episode, which to this point is the only episode we've done on investing. I don't know the exact number, so you're just going to have to find it. We haven't done that many. It shouldn't be that hard. But I do think this, in combination with that other investing, will really be kind of the intro to how we think about markets and planning, and what, in this episode specifically, what we need to think about moving forward.
Yeah.
I'll start. We've been living through an almost uninterrupted bull market for going on 14 years, 16 years actually, since 2009. It's been a really long time. The market is actually averaged rate of return. And when I say the market throughout the podcast, I'm using the S&P 500 largest American companies, just as a bogey for the market as a whole. 16% annualized returns since 2009, right? Since the Great Recession. Even the last 3 years, and we're doing this halfway through 2026, but 23, 24, 25, fantastic returns over those 3 years as well. So take that in one hand. We are living through one of the biggest bull markets in the history of the stock market. Yeah. Simultaneously, if you were standing at a barbecue with friends and you're just trying to make conversation, I don't know, with your wife's friend's husband, and you're just trying to shoot the shit and talk about things, that, boy, market's been crazy recently, huh? Which I don't think you would actually say. That's not really your style. But if somebody said that, the 100% reaction, right, by everybody listening would be like, yeah, it's been crazy. It's gone up. We all kind of internalize like markets have been exceedingly volatile, up, down, and we act like, oh yeah, these are crazy times. And actually, I was looking, and I want to make sure I get this right. The University of Michigan has been doing this consumer sentiment survey going back, I want to say since the 1950s. Right now is the least confident, optimistic in the markets, basically in the US economy, that investors are ever. Since that was done. Again, 70 years. The 1970s, we've had the Great Recession, we've had the tech bubble. Right now, after a raging bull market and 3 specific years of incredible returns, and all anybody can talk about and think about is, oh my God, we're living through a terrible market. Things are awful. These 2 facts exist simultaneously. Mm-hmm. Right? And we see it every day.
It's an actual bias, like a behavioral bias where, like, if things are going well for so long, we just naturally feel like it's all about to crumble.
I'm going to blank on the exact, but it's literally, and this applies to a lot more than the markets. It applies for like history and more things, but basically nobody can remember the generation before them. You remember things that happened in the last like 15 to 20 years. And before that, everything, you can know the facts. Everybody could have the stats I'm about to lay out, but you don't feel it. It feels like another lifetime ago. And there's a specific time frame, where that starts to happen. We've been talking about this, I know, on our spring review meetings with a lot of clients, that one of the dangers of going through a bull market the way that we have, we develop unrealistic expectations about what the market really looks like. Because again, to put it in the simplest term, this is not volatility. This is not a down market. This is just almost uninterrupted positive gains for a really long period of time. Everything we're about to say today is not because we think a market correction is coming tomorrow. Maybe we're already in one when this is filming. Maybe it's not. We have absolutely no idea, and nobody does over the next 6 months. Warren Buffett has famously, and I think he said this for the first time in his 1960-something newsletter, nobody has any idea about short-term price movements. He is not tasked, even in his role, running Berkshire Hathaway, of what is the market going to do over the next 6 months. Let's put that aside. We are not talking about this because it's coming, although law of numbers and just the way markets move, we've had really good times for a really long time, and things go in cycles. So let's put this in a little bit of context, right? Like going back the last 30 years. If we think about the market events that kind of top of mind for all of us, whether you know all the exact data or not, but when we say we haven't experienced anything like a real correction of multiple years in a row going down or entire decades, here's what we mean. 2022, the market lost almost 20% of its value, the stock market. Now, that has since been followed by 3 immediately positive years, so we all kind of forget about it. In 2020, March of 2020, the COVID market went down over 30%, but it only lasted 30 days, and you had a million other things going on in your life, so if you kind of missed that, and then the market rebounded phenomenally the rest of the year, that kind of makes sense, right? You barely had time to think about it. And we've had individual days over the last 6 months where the market went down, but it almost always followed better returns. So these have all been extremely short-lived. Even what we call tariff day last year, again, market went down almost 30%. It was a really bad, especially 2-day period. The whole thing lasted about a month. I'm emphasizing this not because that's what always happens. We're about to get into how that is not what always happens. In fact, it's not what usually happens. But we could be excused, and you as an individual investor, for thinking that's the worst it can get, is a month, is a year. And that's what we want to talk about. So
I think a lot of the people listening to this as well, like their investing timeline has really only been during this space of time where it's just been like naturally good. Yes, right. Down days. Yes, scary news. All of those things are natural. It's just part of investing. But I think what you're acknowledging is for this period of time, it's been exceptionally good in terms of
and that's important because most of our clients are in their 40s, right? Late 30s, some in their early 50s. The last time the market went through a pronounced downturn, 2007 to 2009, most of them were, early 30s, maybe in their 20s. And even if they were at those ages, how much money did they have invested?
Not a ton.
Right? The more money you have at stake, the more that immediate gut punch when the market goes down and you lose money. So to your point, part of why we're explaining this and part of why we're repeating this ad nauseum for our clients is it's coming. We want to be psychologically prepared. We want to understand what it really means for you and what it doesn't. And as I'm going through some of these stats, and even if, do you have like a tennis ball or something?
No, I don't.
Something that you can just like throw at my head. Because when I get going, talking about investing history, like
what you want? I got a mug.
I think I blacked out for like the 4 minutes I just barely got started. So feel free, throw something at me or just jump in.
He's a smart guy and he's got lots to say. So I'm going to let him run.
All right, you indulge.
We'll wind you up and we'll let you go.
All right. You're also like offended that I asked if you had a tennis ball. We didn't talk about it before. It was just the lead in to a joke.
Why would I need a tennis ball?
It was just the lead in to a joke. All right. We talked even last episode, and we've talked every 20-year period in the stock market's history has had positive returns. Every 20-year period in the stock market's history has been up. You would have ended with more money than you started. So keep that in mind as we go through this, because that is the ultimate takeaway we're getting to, is that and that the market has averaged 10% annualized returns going back through 1928, and every 20-year period has had positive stock returns. So let's keep that in mind, because all the dates we're going to share, I'm really building this up like a history lesson. I'll be quick, but includes these time frames. For 2000, 2010 is sometimes called the lost decade for US investing because the stock market actually lost money. You had less money than you started with if you invested from 2000 to 2010. Market was off a little in the aggregate, almost like 1% annually. So it was like 10% down for the decade. 2007 and 2009, if we want to look at that specifically, the market lost more than 57% of its value over an 18-month period. 2000 to 2002, market lost, again, it halved. Twice in one decade, at the beginning and end of the decade, the market literally lost 50% of its value. Now, one of my all-time favorite Charlie Munger quotes, and I'm butchering it. If you can't be chill about the fact that as a stock investor, you're going to lose 50% of your value periodically, then basically you don't have the temperament and don't deserve to get the returns of being an equity investor.
If I were to restate that, something like it's just baked in, right? Like if you are going to invest in markets, meaning invest in companies, you're going to.
If you don't want to periodically see 30, 40, 50% declines, you shouldn't be an equity investor.
Yeah.
Is basically where I was going with that. That was 2000, 2010. Entire lost decade. 1970s, the stock market lost value over that entire 10-year period, meaning you ended with less money in real terms because inflation was so high than you started with. An entire, again, lost decade. In 1970s is actually the only decade where stocks and bonds both lost value relative to cash. Meaning for the entire decade, you would have been in better shape by just putting your money in US Treasuries than investing in stocks and bonds. Chaos for a really long period of time. 1930s, 1940s, the Great Depression, I think that kind of goes without saying. It lasted a really long time. It actually took more than 15 years to become positive at the end of the Great Depression. Why long-term investors still win is everything we started that with. You are better served by experiencing all of those losses and being invested throughout it because, again, for the long-term investor, which we're defining as 20 years plus, every 20-year period you would have ended with more money. The thing you needed to do to protect yourself against those down years and in some case lost decades, you needed to be invested in the 1980s and the 1990s in order to deal with the 1970s. You needed to be invested in the 2010s, and so far in the 2020s, you needed to have those incredible decades, and you were able to withstand the lost decades. You don't get one without the other. And for anybody that says, well, cool, I know the answer, I'll just get out, right? I'll just avoid the 70s, the 2000s, the 40s, the late 60s. I'll avoid all these bad periods. It's impossible. We can share a lot of numbers, data. We both know it anecdotally.
Yeah. Whenever I hear that, I just think, okay, when is the bottom and when is the top? You don't know when those are.
You have to be right twice.
You have to be right twice. Shout out Bridget, sent me the quote, the actual quote. This is what it says. Charlie Munger said this: if you can't stomach 50% declines in your investment, you will get mediocre returns you deserve. There you go.
I think I basically said.
You basically said that.
But that is nicely put. There's a reason he's Charlie Munger and I'm not. I would recommend checking that out. These returns happen. You need to stay invested throughout the entire period. And the last point to that is, yes, you have to be right twice if you're going to get out and get back in. And it's actually the getting back in that's the hardest. Right. Because most of the time when markets rebound, they go up so quickly in such a short amount of time that if you're waiting, you're literally going to miss. You look at every end of a correction, it goes up incredibly high in a really short period of time. Nobody is able to forecast, oh, are we at the bottom? And the other part that makes that difficult, because it comes from both sides, is what's called the dead cat bounce. That's a real thing. I didn't just make that up. Where basically the market's going down and let's say it just stays down and then it goes up a lot in a short period of time. And you're like, cool, we're out of the woods. The recession's over. The thing that caused this market meltdown. And then it goes down even further. Some of the best days in the stock market's history, like individual days, most of them happen during 2007 to 2009 when the market was tanking and during the Great Depression and during the tech bubble. It's during periods where the market is trending down that you experience some of the best days in investing. Why? Because the volatility isn't. Up markets generally just more or less look like up markets. It's down markets that have the room for incredible days. And if you're like, cool, I'm going to get back in because the market's up.
I've never heard this before.
It's a real thing. Trust me, I did not make that
Dead cat bounce?
Yeah. It's one of those things you don't want to think about too much because it's like it doesn't make sense.
It's one of those things that I'm like, if I try to explain it, it's like, oh, this is not good.
Yeah, type of thing. Yeah.
I want to restate what you're saying. I think that the general principle I'm hearing is just, you got to look long, right? Like that's the whole point.
We wish there was a better answer to that, but yes, that is, time solves all investing problems.
Which is so hard to do. I just think, I know you know this because we work with a lot of people. It is hard to look into the future, right? Like it is really difficult.
I would say I thought you were going the other direction. It's tough not to look at the past.
Yes,
right?
That too.
And that's where I want to stay for a second. So This is where psychology enters the conversation. Like the way we think about money and gains and losses, it's called loss aversion, which is the idea that losing money hurts twice as much as making the same amount of money. This was actually in a book we like, but if you read Andre Agassi's biography, it took him a long time to win a major, and he was getting a lot of shit from the media because he was supposed to win one already. And when he finally won his first Wimbledon in '92, he wrote about it in his book. He's like, I wish I knew that winning doesn't feel as good as losing hurt all those years. Mm-hmm. He's like, I know something that not that many people get to know, which is that once you win, it's like that, it's gone. The losses stay with me. It was kind of a depressing chapter of the book, but that is actually hardwired into human psychology. And I'm applying it to investing, obviously, but we feel the pain of loss twice as much as, in this case, making money feels good. Why is this so important? Because we keep throwing out stats of every 10 years in the market and 15 years. If you invest for one day, you have a 50-50 chance of making money. Statistically, the market is up, changes every day, obviously, but in the ball, 52% of all days in the market over the last 100 years have been up, which means it's basically a coin flip. Which means if we feel lost twice as much as we experience the thrill of winning, the more we look at our accounts, the worse we're going to feel. It is baked into our psychology that you are going to feel worse. We want to answer the question at the start of how have the markets done so well for so long and everybody feels shitty about investing in the markets. It's this. It's that if you're looking every day, half the time you're seeing downward stock prices and you're experiencing it a whole heck of a lot more than the up days. So just do the math. You're feeling shitty most of the time in a way that doesn't make sense. And that's the daily experience. And what's compounding that, right, is, what did I say at the start? If you look at your accounts every day and you see that half the time the days are up and half the times the days are lost and you feel worse about it, yes, I'm repeating that intentionally, the more you look, the worse you're going to feel. If we could set up a fund, and I think Warren Buffett actually has said this, if he had the ideal fund, it would be you invest, they don't send a statement, no online access, basically money stays invested for 30 years.
You don't see it.
You get a statement once every decade. We'll give you a statement and that's it.
Sounds
because
great.
The less you look, the better returns you're going to have. It almost sounds like I'm not saying that literally, although I'm also saying that literally. The less you look, the more you're going to be rewarded because you're letting more time pass. You're giving yourself more chance for your accounts to be up. And then you're not going to react negatively and think you need to change a lot of things and do a lot of things differently because every time you look, it's up because you're only looking once every 10 or 20 years. The math is in your favor.
Before you transition to the next point, I'm always the person relating back to something completely unrelated to finance, but
I just brought up Andre Agassi's 92, so we're on the same page. Yeah.
There have been times in my life where I've done a sprint on something, meaning I want to get really healthy. Right? So on one of those, I'm going to work out every single day. I'm going to keep my macros are going to be this is what's going to be. And I had a checkbox every day. And if I missed one day, I felt terrible. But then I remember getting to the end of it and I was like, I made great progress. Right. Huge
right. You
gains.
could do things right. You did it right for a week and then you were just pissed that you missed that one.
Yeah, and I looked at the whole thing and I was like, over the last 90 days, maybe I messed up 5 times. For some reason in that week, I was like, I'm the worst person.
Right.
This is terrible. And I think it's very similar to this.
Yeah, 100%. It's the exact same thing. The less you look and taking, not compliments, but you did a great job reporting yourself or knowing hey, Mark's up, I'm going to take the win.
Yeah.
Take the win and move on and focus on the next thing. Now, I don't like using the boogeyman, the media, but yes, the financial media, everything is set up to make all of this more difficult.
Right.
If I ran the financial media, the entire the page would be the chart showing stocks going up. Instead, I would just write check in next year.
Yeah.
It would just be one chart, check in next year, everything is fine. Right? Every day there's a new crisis. There's a new reason that the markets might go down. There's a new product strategy. I know we've talked about that in terms of simplifying all of our stuff. Our answer, again, is not don't look. Ignore the financial media. Don't look at your accounts. I know a lot of our clients who say, hey, I love not having to look because I know you guys are. You're watching this all. And every time we get together, you're going to give me a State of the Union in a way that I don't need to be so hardwired into all of this. But the better answer is not just don't look. It's a little ridiculous on some level. It's have a system, an investment program that's based on things that are true today will be true 5 years from now and 10 years from now. And it's evergreen. It has absolutely nothing to do with what's going in the markets today. And if you build your investment program on day one with this structure and you know what's going to happen in your accounts all over and over again, you're going to react less emotionally, react less at all, because you have this in place.
You're then shifting the judgment of your success not on what's happening on the outside and more just is the engine running? Is it doing what it needs to do?
Trust the process.
Yeah.
That's really what we're saying is have an investment process that you can trust in good times and in bad. You're taking the emotion out of it because you're maximizing your behavior. Yeah. What does that look like? We want to give specifics. We're not going to spend the whole time on this, but number one is the reason we start every relationship with a plan, not investments. If we know what the goals are, your cash flow, your savings rate, your income, your expenses, and then we build the investment plan surrounding that, we're not going to make changes to your investment plan because of a war in the Middle East, or because interest rates are going up. We're going to change it because you and your wife decide you want to go from a 2-income household to a 1, or because you're deciding your kids want to go to private school instead of public school, and we need to reframe the conversation. So that's number one. Start with a plan, because then when you're thinking about money and finances, you're not thinking about the markets as it's like hypothetical boogeyman. You're thinking about your financial plan. Number 2, have enough cash. Have enough cash, 6 months of living expenses. We've talked about, for some clients, it's more like 12 months. For some clients, it's 6 months plus enough for a down payment, which might take 3 years of building. So we're keeping a lot. Having enough cash that's not invested, that allows you to do everything you've ever wanted to do over any given 2 to 3 year period, means you don't have to worry about when the markets are down 30%. Sure, your long-term money is down 30%, but your short-term money is exactly in the same position it was yesterday when you need it. Right?
Yeah, you'll still be able to do the things you want to do and plan on doing right now and in the future.
Right. The markets are not changing any part of your financial behavior. Number 3, dollar cost averaging. Now we're getting a little bit more into the actual investment setup. Dollar cost averaging means adding the same amount of money every single month into your investment account. So if you say, hey, I have $10,000 a month that I can invest, when is the best time to invest? When you have the money, right? Because most of the time markets go up. So if the math is just in your favor, by investing when you can, not waiting. And while you're waiting, the market goes up, because more often than not, that is historically what
it is
happened.
super common. And I know you get this too, for me to get a client that's like, we'll talk, it's been a year or 6 months, or it's our first time talking to them as a client, and they'll just have like a ton of cash sitting there. And we'll say, what's that for? And they're like, well, I've been waiting to put it into the market when it's good. It's like, well, the market's been doing great for the last 6 months.
And so what does it actually do? Like, the actual math is in your favor. If you had $10,000 a month every single month, in months when the market is doing really well and is really high, you're going to buy less shares. Your $10,000 is buying less shares of everything you're buying.
Yeah.
If the next month the market loses 30%, you're buying 30% more of all the companies you want to own. It's going into a store and buying, there's a 30% sale, and you're going in with the same amount of money that you were going to go in with yesterday, except now everything's on sale. And if you do that every single month, and our clients are doing that not for years, but for decades, by definition, over a long enough time period, you are buying the most amount of shares at its lowest price and the least amount of shares at its best price. It's a way of saying, in a way, you're timing the market by not trying to time the market in any way, shape, or form. That consistent saving, investing behavior means, because again, if the market's really high, you're just buying less shares. You're not taking more money and investing at a bad time. You're just buying less of everything. And next month, it's going to work out a lot better for you. So that kind of consistent behavior. Diversification is next. There's a reason we are never talking about, we want to buy these 5 stocks, any individual stock. The 20-year rule, not a rule, it's history, that every 20-year period in history has had positive returns. That is not the case for individual stocks or individual sectors, right? In fact, most companies, most stocks lose money over time. Something like 4% of all publicly traded companies, going back 100 years, have made money. 4% of companies are responsible for 100% of the gains. Most publicly traded stocks break even, like you're not making any money, and the rest of them actually go out of business and just lose it all. If 4% of companies are responsible for all of the gains, and by the way, this applies to the unicorns of today as well, right? The biggest companies in the world, if you want to go back and look what were the top 10 largest companies in 1995, 30 years ago, and what they are in 2025, totally different. I think there's one holdover. Trust me, the people in 1995 were just as bullish and confident in the largest companies of their day as we are in ours. Right? So this is when we say diversify, we literally mean we want to own every sector of the market. We want to own US and international, small cap and large cap, tech and growth and value and dividends and everything, so that we're not ever taking a gamble on one sector of the market. We're taking any investment thesis where you have to be right. And that's the best definition of diversification. Diversification means having good enough returns without ever having to be right.
Yeah.
And again, if all of these build on top of each other, all of a sudden you have a pretty good investment program that can withstand any of the crazy years you spoke about earlier.
Yeah. It might have been Charlie Munger that said, don't find the needle, buy the haystack.
My favorite Jack Bogle quote.
Oh, Jack Bogle, yeah.
I think I called him John Bogle in another episode, so my apologies. But yeah, instead of trying to find the needle in the haystack, just buy the haystack. It's nice, right? That's a good quote. Feel free to use it. I don't know when this would come up in everybody's lives, but it's one of my favorite things, so thank you. We're wrapping up. The last piece is just to be tax efficient, to keep taxes in mind when you're investing. This means things like tax loss harvesting and taxable accounts, tax location, which means if you're going to own a bunch of different types of stocks, and even if you're going to own some fixed income, put the money in the tax vehicle that is going to do the most good for yourself. In terms of look at your investments as a household and optimize for the household rather than each individual account. You don't need to have any knowledge of what's coming in 6 months. in a year, in 5 years, and 10 years. You can build this all at the start and continue to maximize and optimize this year to year. And it'll give you the confidence to know you're doing the right things, even as the world is chaotic and swirls around you. Anything we want to wrap up with before we get you on your plane?
Yeah, I just want to summarize what you said, because that was a lot of really good stuff. The things here, as I would kind of restate them, is what would this strategy or this plan, this system look like? Number one, you got to have a plan and got to operate within that plan. You're reacting to the plan, not the headlines, right? Number two, make sure you have enough cash. Number three, dollar cost average, meaning just save regularly, right?
And invest regularly.
Invest regularly. Number four, diversify, right? Don't buy the needle, buy the haystack. And then the fifth one was all about tax strategy, right?
Just have one.
Just have one.
For the sake of this podcast, if somebody asks, hey, how are you investing from a tax standpoint? Have an answer.
Yeah, yeah. And I think, and I would agree with you, right? Like, if that's the system that you're operating within, that's the thing that you can question, every couple months, is my system still working? And you might need to make tweaks to that system every so often.
Yeah.
And that's fine. Like, that's a good, appropriate thing to do. But you want to make sure the system is running.
With that, Jordan's out of here. I'm going home. Have a wonderful week, and we'll catch you next time, next Thursday.